Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
Jonathan Pingle all over the place here. Jonathan Pingle, Chief Economist at UBS Securities. He joins us here, PhD from this school down in North Carolina. I can't remember the name, but Jonathan, thanks so much for joining us here. What did you hear from our Federal Reserve Chairman yesterday? Anything to change your economic outlook?
Nothing that really fundamentally changed our outlook, but I have to say the way the chair handled the press conference was pretty different from what we thought. I also have to set the record straight. At 5'11", I did not play basketball at UConn. I did think it was actually a pretty unique. Might be a stretch, but I thought it was a press conference where, the chair really threw it back to the data and almost completely got out of the business of trying to guide markets about what was going to unfold with monetary policy.
Let's get some perspective from yesterday. Alarian of Cambridge.
Tom, what I'm worried about, because I truly believe that this is not about lags, that there are structural aspects that are running the equilibrium inflation rate higher than it has been in the past. I worry that the Fed is going to be over tight this year. I worry that the Fed is not going to end up cutting because they're going to be so data dependent, so reactive, that they're not going to look at the weakness that's coming. Right. In fact, if you simply read the earnings reports of McDonald's, Starbucks, PepsiCo, Nestle, the list goes on, there is no doubt that low-income consumers are struggling. Their balance sheet effects have gone from positive to negatives. The pandemic savings are run down. Their credit card balances are high. They rely entirely on the labor market, entirely on wage income. And if something goes wrong in that labor market, we are going to see this economy slow much faster than anybody would like it to slow.
Mohammed Alarian, University of Cambridge, he'll be with us next week, I'm told. And what's so important here, Jonathan Pingle, is I alluded to it yesterday, the societal impact here. Is this the Fed running policy for the financial markets and the fancy people? Or are they actually looking at the split in America of a lot of people struggling with labor, struggling with jobs, struggling with inflation?
So I wouldn't phrase it as they are looking, let's say, at the aggregate. But Tom, I really do have to agree with the question you're asking and Mohammed's general thrust. When we look at what's unfolding in the economy, 2023, the Fed had to fight a lot of fiscal thrust. And while that was happening, you're watching net interest payments for households rise. But if you think about, net interest payments rising for households and the households paying the higher interest rates, that's not the same household as the one who are earning the net interest income. And we actually changed our economic forecast last year. We had been predicting, weakness, seeing this deterioration amongst sort of indicators like delinquency rates and fewer and, cardholders paying minimum balances. But when we broke down how wealthy households were by income bucket, the upper 20% of the income distribution is just awash in cash, liquid assets, and high levels of wealth. And they do a lot of the spending.
Paul wants to get in here, but Paul, I can't tell you how this is almost like British economics. And there's a whole heritage of this in Chicago as well. The idea of aggregating our economics now in America, I mean, Meltzer used to yell at me and say, Tom, you got to aggregate. How do you aggregate in this economy with half the nation flat on their back.
Exactly right. So, Jonathan, are you of the opinion that, I mean, there's a lot of folks out there, both in academia and in practice, that are saying this Fed is already behind. They should be cutting rates now. That if you look at the real-time data, inflation is in fact, I'm not going to say whipped, but certainly under control. How do you think about the Fed, and are they behind?
Well, I think in a way they are. I mean, one of the reasons you can have that sentiment also, if you look at a Taylor rule, and John Taylor was no dove, and you think that, their long-term dot or policy, the median is, between 0.5% and 1% real, the funds rate should be 100 basis points or more lower by most of those rules. So you can really make that case. But I think one of the things the Fed's doing is it's almost like they've got a short run neutral rate, and they're updating that with every payroll report. So they've seen sort of the strong economic data, that sort of has bolstered their case that they can wait, and they can keep rates elevated even relative to the progress they've made on inflation.
All right. So as we sit back here, Jonathan, are you comfortable? Well, let's just start, get the UBS house call on GDP. How do you think GDP is going to be for the rest of the year and then for next year?
Yeah, I mean, we think GDP is slowing to roughly 1.5% this year, and then the next 2 years is going to run roughly between 1.5 to 2.
Is that staggy? I mean, Powell said there's no stag, there's no inflation. Does Pingle say there is stag, there is inflation?
Well, we think inflation is going to generally cool over the next few years. Staggy, I don't know. No, I mean, we're not really telling a stagflation story. I mean, we're telling a story more where the economy really is going to slow. A lot of the fiscal impetus looks like it's coming out, and I think that is going to help price pressures.
John Pingle, we got to go, but with your basketball heritage at Connecticut, Sixers or Knicks? What do you think here? Sixers or Knicks? It's getting exciting.
I'm kind of I grew up in New York, so I'm kind of a Knicks fan.
Okay, Jonathan Pingle for the Knicks there. Thrilled to have him on with all of his prowess at stores as well. He's with UBS. It's a Swiss bank in America. Right now, we do this once in a while where we go from, like a really basic conversation, we're going to get fancy and pro. We can do that with Stephen Englander. He is with the Standard Chartered Bank, and with our question is the #1 cross-rate currency strategist in the world. Steve Englander, really honored to have you on the show today. My basic teaching here, Rudy Dornbush 101, is unilateral intervention doesn't work. Japan has put in a first amount of money, a second amount of money. I guess they have an unlimited piggy bank, but they're really getting nowhere. When do they raise interest rates?
Well, I think that's their problem, that, you can think of intervention as sending a signal that you are going to raise interest rates, building a bridge between a point in time when you're not yet ready, but kind of saying, hey, down the road, it's coming. So far they haven't sent those signals, and my guess would be, they haven't confirmed the intervention, but my guess would be that they've actually put a basket full of money into it. We'll have to see if it succeeds. They tried if it was intervention, it was in a very illiquid part of the day.
I got Euro yen at 165. It's not succeeding. Steve Englander, what I find so important here is they have an overt national policy to reflate. Has that been successful? From where I sit, it's ephemeral. It's almost a fiction. Have they successfully escaped the disinflation and deflation of decades?
I'd say somewhere between a 4 and a 6 out of 10.
And imagine what the East German judge gave him. Continue, Steve.
Yeah, I think that the issue is that you're reflating by making yourself poor, right? Because the stuff you buy from abroad is more expensive. That's not what they really wanted in terms of reflation. But you do see some sign that wages are picking up. So to say that it has completely failed is wrong.
Paul Sweeney, the late Martin Feldstein would be screaming right now. This is just bad theory.
Well, that's
all there is to it.
That's kind of where I wanted to go. Steve, I mean, just historically speaking, for those of us who don't follow currency markets that closely, Do interventions usually work or ever work over the intermediate to long term?
Oh, I mean, that's such a controversial question. And it's not even clear why they should work because, most of the time what you do in the foreign exchange market, you undo in your domestic market.
Exactly.
So, there's no change. But like I said, sometimes if the market sees it as a signal that you're ready to change policy, that something fundamental is going to shift, sometimes it makes something that would have happened in 6 months happen now. But there has to be the thing that's going to shift. And so far, they really haven't sent a very strong signal that anything is changing.
Okay, so what should we watch for, Steve Englander? If we announce they're 0 for 3 now and 0 for 2 recently on some form of unannounced intervention, what's the to-do list for the leadership of the nation? From where I sit, they've got to capitulate and get to a normalized rate structure. Am I wrong?
Well, you can't have everything, right? So, you can target your exchange rate, but it means that you have to change your monetary policy. You can shut down, your capital markets, right? Make it harder for money to leave, like, China and some other countries do. But if you're saying we want open capital markets, we want monetary policy to be dictated by domestic fundamentals, your exchange rate it's going to go where the market wants to take it.
Okay, let's go with Standard Chartered Bank. And folks, Standard Chartered Bank is definitive Pacific Rim and more EM analysis. Bill Winter leading the charge there. Steve Englander, from the Standard Chartered view, how will the Pacific Rim countries, led by a 30% appreciation of Chinese yuan versus yen, how does Sing dollar, how does Taiwan, how does the ringgit, etc., how do they react from this madness in Tokyo?
If we were having this conversation 100 years ago, you'd be asking that question about, sterling. If we were having this conversation 40 years ago, the yen would really matter because they were this export power. And on the margin, they were this sort of competitive edge. Now they're kind of in the pack. They're in the peloton. So, I mean, one thing that's really clear, you would expect that with that kind of depreciation, Japanese exports will go to the moon, but they haven't. So I think the impact on the rest of Asia is much less than you would have expected. Nobody likes it, but the bad part that you would have expected from the yen being so weak and in theory being so competitive, that's just not showing up.
Steve, when you talk to your institutional clients over the last several days, are they buying the yen?
No.
What do they?
I think
what do they need to see to step in, do you think?
Well, as we were saying earlier, I think they need to see some sign that rate differentials are narrowing. As long as they're 400 basis points between the U.S. and Japan, you'd better be convinced that there's a truckload of yen buying going to come from somebody to jump on it. And I'd say that most of them would say if it went down to 150 or 152, we would be selling yen, not buying it.
Okay, well, let's finish up with this. The impossible trinity is goaltending and defense and offense on the Montreal Canadiens. That's the original definition of impossible trinity. I'm doing this for Englander of Montreal and to the late great Tobias Lefkovich. Yep. Steve Englander, just simply here, there's an impossible trinity. Krugman wrote the book on this. What do they need to do now to stop this intervention juvenility? What does Japan need to do?
Look, it's a tough one. And, I'd say on the Canadians, I'd take 1 out of 3 out of that trinity at this point. But I think the BOJ just has to, sort of suck it. I mean, look, a lot of countries in the world, they've raised interest rates. We've seen it in the U.S. The damage hasn't been as bad as expected. It's possible that the Japanese economy won't, fall on its face if they raise faster. But they kind of have to decide. We touched 160. Was a big level. They clearly didn't like it. Perhaps they'll say, look, it's the damage from a weak yen is enough that we're going to change monetary policy. But there's no magic bullet there.
Steve Englander, thank you so much. Can't say enough about it. Steve Englander with the Standard Chartered Bank. Now joining us, Professor Feroli, of JPMorgan. Again, it could be a 1-hour conversation. Michael Feroli, what I witnessed yesterday was the biggest amount of hopium I've ever seen. I mean, I'm sorry, Michael. I'm looking at, and they're all doing the parlor game, how many rate cuts and all that. What is the underlying, if you're in class with Richard Portis at LBS, Michael Feroli, what's the underlying theory of this Fed?
I think the underlying theory is that rates are restrictive and that over time that will have a moderating effect on inflation. Now, I think, there's a couple things there, but I think another thing I heard that maybe I didn't see so much commented on is that, I didn't feel like he thinks that inflation at 2.7 or 2.8 is like an emergency situation, right? Which is interesting because if you go back, 15 years 15 to 20 years when we first started debating a formal inflation target, there were a lot of people saying, a comfort zone of 1% to 3%. And obviously we settled on 2%. We're not there, but he didn't really seem to think that 2.7, 2.8 is right. Something that is worthy of really risking growth.
This is why this is the conversation of the day. Michael Feroli, ages ago, set the potential GDP of the nation under 2%, and there's this raging debate about should we panic with inflation at this level right now. Clarida, the former vice chairman, Richard Clarida, Michael Feroli, has suggested we're going to bring up the 2% level. What do you and Bruce Kasman and your team say? What is an appropriate blended, banded target rate for the new Fed, the next Fed?
So if we're talking about real GDP growth, and we're talking about potential real GDP growth, normally we think of that as something that's going to, obtain over on average the next 5 years or something like that, right? I think in this particular situation, it's hard to get around the issue of immigration and how that's affecting trend growth. So just to level set here, over the past 12 months, we've averaged payrolls around 250,000 per month, job growth 250,000 per month. And in that period, the unemployment rate has trended up on sort of averaging out about 0.3 of a percentage point, which would tell you, all else equal, that steady state job growth could be above 200,000, right? And if that's the case, then I do think potential GDP, if you want to put it that way, over the past year has probably been above 2%. Yeah. Certainly we've had growth well above 2% over the past year. Again, alongside no evidence of tightening in labor markets, no evidence of that tightening in inflation data or wage data. So I do think currently, the full employment growth of the economy is above 2%. Now, I started off by saying normally we think about, potential GDP growth as something that's going to obtain over long stretches of time. And I think in this situation, it's a little more tricky to say because, the prospects for immigration into next year, I think, are going to depend on, policy choices that are made regarding immigration policy, which could, dramatically affect whether that 250K number I mentioned earlier is going to be something that, rolls on into 25 and beyond. Right?
Michael, how concerned are you about inflation? Because I think there is a debate out there in the marketplace whether what we've seen over the last 3 months is something we need to worry about or not. How do you think about it?
I still think we're on a disinflationary path. For one reason, I guess if we can either come at it from a bottom up or top down. I think in the bottom up, Chair Powell a few times yesterday laid out the case for why rental inflation is going to come off. And if rental inflation normalizes, then I think that gets you, a good chunk of the way back to a more, acceptable inflation rate. And I think you could see that in things like, in Europe, they use this HICP, which is basically CPI minus OER. The BLS here in the U.S. produces one of those, and right now that HICP is a little over 2%. Core HICP is a little below 2%. So, basically from the bottom up, if that, if those rental measures come down, that gets you a long way there. And from the top down, I don't really see in a big way inflation pressures picking up in the first quarter. Now, I know earlier this week you got that disappointing ECI, but at the same time, some other wage measures have been a little less worrisome. And I guess most importantly, inflation expectations still look pretty well.
Right. Feroli is talking like he's a president of the New York Fed. I mean, he's on the edge of Goolsby.
Exactly.
He's like on the edge of Austin
JPMorgan. Hey, Michael, there are folks out there in the marketplace, both academics and practitioners, that say, you know what, this Fed's just way behind the 8 ball here. They should be cutting rates now. Inflation is, in fact, under control if you look at some more real-time data. Do you share that view?
Not necessarily. I guess I do buy in. Look, there's a risk they are behind the ball, right?
Yep.
I think if that risk pans out, if tomorrow morning we get a real, dud of a payroll report, then we'll find out they were behind the ball. But I think if we're behind the ball, if they are, they can catch up pretty quickly, right? They can, they can cut quickly. They can cut in larger increments than 25 basis points. So I think it's a risk, but it's a manageable risk.
Right. Michael, I want to bring it over to the labor economy. We've got the jobs report tomorrow. And Anna Wong was heated about this, and that we have a fully employed America. I get it. But what we're hearing from our listeners and viewers is that's just flat out wrong. Are we a fully employed America into the jobs report tomorrow?
I think we are, but I do think there's signs that the vigor we're seeing in labor market activity is moderating. And I guess to your point about, Americans saying, well, that's flat out wrong. Yesterday we had a consumer conference, the Conference Board's consumer confidence number, which, and again, Chair Powell mentioned this yesterday. Within that, they asked people, are jobs plentiful? Are they hard to get?
Yeah.
That's been pointing to some loosening up in the labor market. Still, overall, if you look at that, consumers are saying jobs are still pretty plentiful. So I think we're fully employed. We're probably moving in a direction where, again, the vigor of hiring is certainly slowing. Gross hiring is slowing. The appetite for new postings of vacancies is waning. So, yeah,
okay.
I think it's a bit nuanced.
We're
fully employed, but not right.
Got to leave it there. Michael Feroli, thank you so much with JPMorgan. Your daily front pages without Lisa Mateo. John Tucker, the newspapers.
All right, I got to admit, a disclosure up front. Some of them aren't front pages. I had to go to page 6 for a few of these.
That's our warning.
Just your warning. Yeah. Let's start with this one from Bloomberg. Elon Musk's latest cost-cutting victims, summer interns. Tesla rescinding offers just weeks before the internships were set to start.
You got to be kidding.
So this has prompted aspiring employees to take to LinkedIn. They're appealing to other employers to try to take them in. Here's one. I'll read right from it. At 8:46 a.m., I opened a Tesla email for flight information. By 11:25 a.m., my internship offer was gone, wrote Miami University student Joshua Schreiber, who said his start date was 3 weeks away and that he had already spent thousands on housing. Like a lot of other would-be Tesla interns, getting uncomfortably close to the end of the school year. They say the surprise calls from Tesla informing students that their offers no longer stand have left them without a lot of time to find replacement gigs for the summer. So one part of me is like, these poor kids. The other part of me is like, yeah, welcome to the real world.
Yep.
Anyway.
But I mean, Tesla, it's such a mercurial situation.
Can I use the word erratic?
Yes,
okay.
You can.
All right. This, you're just talking about retail. This comes, interesting article from Women's Wear Daily.
Yeah, I read it every day.
A great read from Evan Clark. When Jeff Jeanette came to the phone in November for his quarterly report as CEO of Macy's, he had a long list of accomplishments from his nearly 7-year tenure at the top. He also had one acknowledgement telling WWD that Really consistent, profitable growth had eluded him. There's a lot of change and challenge all at once. Macy's, you have Nordstrom, Dillard's, Kohl's. They collectively drove nearly $63 billion in sales last year, marking a decline of $3.2 billion. It used to be that customers needed those department stores to do all their one-stop shopping. Now you can click your way to anything. And more than that, the department stores, according to this article, losing their connections with consumers and with the fashion ecosystem that they actually once supported. So the end result, the analysts are saying, you got to scale down.
Yeah, Steve Sadoff at Saks inventing the word exclusive, and now at MasterCard, I believe they're chairman. And Steve Sadoff once said to me, they finally have figured out inventory management. And people don't go to the department stores. They got to go to the actual store of the brand, and they're afraid they're going to run out of whatever they want.
Yep.
That's the whole emotional thing. Get that blouse now because it's going to be gone, which is radically different than what it was a decade ago or so.
This one comes from the Journal this morning. There have always been people who relish driving their cars until the wheels fall off.
Not me.
That would be me. Anyway, the cost of car ownership keeps skyrocketing, so more and more people are doing this. The average transaction price of a new vehicle, $46,660 in March. Compare that with around $39,000 just a few years earlier. This, according to Edmunds. Repair and maintenance costs up 8.2% year over year. Insurance costs up over 22%. So the increase in the car costs, a lot of developments that have led to inflation. To cope, owners squeezing more life out of their current ride. U.S. vehicles' average age hitting 12 and a half years in 2023.
12 and a half, you said?
Yeah.
How old's your ride, John Tucker?
I don't know. 2019, I think I bought it.
Okay.
That's Bush the first, not Bush the second.
That's like, I've already got over 100,000 miles on it, so it's 110.
I mean, help me here, Paul, because you're riding the fancy car. The fact is all this stuff is more expensive because the cars aren't like we knew as kids.
No, it's...
My father took the knob off the radio and only used pliers to turn it so we wouldn't screw around with the radio.
I told you the story. My old man bought the pickup truck for the farm. To save costs, he didn't put a radio in it.
Yeah, exactly.
Like, who needs a radio? We're working.
We did that. But now, what do you got? How can you land on the moon in your car?
Absolutely. It is all... I just bought a new car the first time in 10 years, and I was shocked at the amount of technology that's in there. And it's like having your iPhone is the car. And
so you said it's up 8% to fix it. Why am I surprised?
Oh, no, it's well, you have to pick the right kind of car. I would say you have to factor in the cost for repairing it before you... BMW. I'm sorry, Paul.
Exactly.
Anyway, let's finish with this. This is actually from Bloomberg Opinion. They're doing a riff on it. There's a cutthroat secondary market for reservations in Manhattan's hottest restaurants. So you have to fork over serious cash just to get into the front door to the people who go online and make reservations under a false name and then sell it on the secondary market. But it could get worse. There's the reservation system followed by high-end establishments in Japan. They don't allow first-time customers. They only let in regulars and their guests. So
there's a restaurant in Midtown that will be nameless, which it's very solid American food. And I quit going because it was so pretentious about the pecking order of who got in the door. And I happened to be on the pecking order lower, but the way they treated you, it was really like swarming. I just want a meal,
Just sort of tangential to this, Tim and Carol on their show, they had the head of the Michelin Guide in. Absolutely fascinating discussion. Yeah. And also, there's a restaurant at Disney World in Florida that is now got a Michelin rating.
Yeah, wow. David Gurr went to it. Yeah, his kids went to it.
Could you imagine that? And I don't think they let kids in.
No, he got his kids in because he's David Gurr, and he ordered, and the kids didn't finish their food, and he almost left them there.
Yeah,
it cost a fortune.
It does.
Jon Tucker with the newspapers. Yep. Thank you so much. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.